Great. Perfect. Okay. Welcome, everybody. We'll just give it a couple more minutes before we start intros and all this stuff. We've got several people still entering the room. Happy to see you today on this rainy, gray day. There's no better day than to talk about finance and money. So we'll just get started at 12:02. We are recording this session. But it will be a bit interactive, so you're very welcome to raise your hand and ask questions in the meantime during the presentation if you have something burning to ask. If something is burning, that is another question.
Yeah, but if you've got something actual burning, you should go do
Yeah,
something
maybe we
else
should
rather
go
watch
do
us.
something about that.
Yes. Finance and fire do not mix.
Yes, that's exactly it. No, they do not.
Although I find that's usually the problem on a Friday afternoon at 3. Something catches on fire, whether it's literal or whether it's figurative, but
Oh,
something
yeah.
happens at 3 in the afternoon.
The boss is emailing you and calling on the phone.
It's when somebody forgot to send a truck to pick up
Oh.
your inventory for a booth, or we have some war stories we can share, because accounting is not just about the numbers, it's
Oh,
about the
no.
operational side of things, right? So
Yeah, I'm sure you have to have like deep knowledge and participation in all things within the business.
when you're
Accounting.
nosy like me, yes.
Yeah, which probably makes you an amazing accountant as well.
I'd like to think so, but we'll find
Yeah,
out. Hopefully the end result of this session will people feel the same way.
I'm sure. I'm sure. I have no doubt. Okay, so then as promised, it's 12:02. I want to say thank you everybody for being here. I'm sure we're going to get some people coming in as we go. Voila. And all right. So Mark, I'll let you let the people in right now as I say thank you so much to Growth Partners for being here with us today. My name is Samantha Goodspeed, and I am program coordinator for the UTest program. And UTest is a University of Toronto early stage technology program. And as the name suggests, we work with early stage startups who have technology and intellectual property coming out of the University of Toronto, but also affiliated hospitals as well. And so we are one of 12 accelerators startup programs within the University of Toronto campus. And we are very excited to have, again, growth partners, Mark Young, Irene DeGoyer,
You got it.
I'm sorry.
No, you got it. It's a tough one.
Yeah, I think it's just like being half French Canadian, half English. It's just like rammed into me, the soft ER.
Hmm.
Friend growth partners. And they're going to tell you all about accounting and building a tech stack in your business, as well as some of the financial models that you should be looking at, all at a very high level because we have a lot to cover today. So we're going to go very broad. And if you want to go deeper, we can do that too another time. So I will leave it to Mark. Thanks again, and you can take it away.
Yeah, perfect. So I'll start with the introduction for Irene here. Do you want to start?
Oh, sure. So thank you so much for coming, everyone. I'm always excited to meet early stage founders. And if you're a little bit beyond the early stage, then you're welcome as well. As Samantha mentioned, this is a kind of a high-speed overview of the things that I've seen as a CFO in many, many startups. And what makes sense at the early stage is different than what it makes sense for at the end of the stage of, or much later maturity for companies on the both finance and the tech stack to help support your finance. I am one of those individuals that I love taking all operations, sales, marketing, R&D, innovation, and it helps to inform the storytelling around the numbers. So I'm hoping you find this useful. It is high speed. I am trying to tailor it to the audience that isn't, perhaps in much further in their career. So hopefully you'll enjoy it.
Yeah, great. Thank you. So, yeah, like a bit of background myself. So, I'm the head of the tech and onboarding side at our firm. So that just really means like all of our clients, my goal is to try to make their systems and processes as efficient as we can. to ultimately save them time, but then also give them the information that they need to actually effectively run their business. So it's pretty broad in terms of what I touch. Like it is mostly accounting, but then at times I have to touch sales or operations. So I've got my hands a bit dirty in a couple of different sections. So yeah, excited to talk a bit more about some of the tools that we use.
All right. So we have an agenda that basically divides the presentation in two. One around accounting, finance, cash flow, and one around the tech stack essentials. I'm going to take you through some of my top advice for accounting, and this is not going to be about how to do a debit and a credit, but it's really going to be about the things that I think you need to know to run financial reporting behind the scenes, as well as talking a little bit about the difference around personal versus business organization. So are you an incorporated entity or a sole proprietor? And then my favorite conversation all around cash. So managing your cash. And then the question is around whether you have to go it alone. I'm not going to talk about running the business, whether you want a partner or a group of people to help you run the business, but more about whether you need to do your accounting all by yourself. On the tech side, as Mark has said, we're going to talk a little bit about what the approach is at the right stage for your business to have a good, solid financial tech stack that allows you to integrate kind of different sources of information. And we're going to talk a little bit about implementation and how to set yourself up for success. As Samantha already said, feel free to raise your hand. And if you have a question, and Samantha will lob them back to either Mark or myself as they come up. All right, let's talk about accounting. And I was thinking about my time at U of T because I am a graduate of the commerce program, and I will not give you the year. So, but there was no Rotman at the time. So it was just a U of T commerce through the arts and science. And I remember taking all kinds of really interesting courses and information that in my career I have either never used again or information that has been incredibly important in my career. And I was thinking about it and I thought about the difference between what I learned in school and my very first job. And it's very different doing real life accounting in a company versus the courses you learned at U of T. And I will say, I was thinking about it, it's like no one cares about lease accounting. It's one of those things we spend a lot of time on, but it never really was useful in my career. Might be in yours. I will say the most useful course I ever took was corporate finance in third year. That I still have that textbook today. So in case you are an early entrepreneur, maybe you're still at U of T, there are some courses that will stick with you over your lifetime. I will say, no one cares about the underlying accounting. Everybody cares about profitability, a path to profitability or profit itself, whether that's at the unit level or at the business level. And then I'm feeling that you need to have practical accounting to make decisions so that you're not sitting there with information or you're trying to make a decision without having accurate data in a format you can use. So I was thinking about accounting top 5. And from this perspective, the best thing you can do to make anything work for you, and it doesn't have to be accounting, it could be your go-to-market, it could be if you're in a healthcare or you're looking at your customer acquisition, regular recording is the key to making this work. You know what's really hard is when you do nothing for a year and then you hand off your bits and pieces to an accountant and they start putting things together and you get some really bad surprises that you thought you were profitable, you thought you had runway, you thought you had enough cash, and then you don't. So if I can leave you with my top #1 thing is that you have to do it regularly. I used to have a rule that every Monday at 9 a.m., I'd get to my office, I'd grab a coffee, I'd sit down, look at my cash flow, look at my sales from the week before. I talk to my people around the office to really get a sense of what that looks like. The second top, I don't want to rank them all, but I see a lot of companies where they don't really think about revenue and the costs to generate that revenue. So they may all talk about gross sales. So that's the very top line. Or my favorite, where they look at what their product sold or their enterprise sold through someone else, and they use that sales number. Real sales are the sales you make, by the way, not an extrapolated value of what someone else is selling it for. And you need to know what the deductions are, meaning, do you have outbound freight? Do you have deductions related to bad debt? You want to focus on net sales, because that's what you're going to collect. That's what your profitability is going to be based on. It's not about gross, it's going to be about net sales. If you're talking to banks, if you're talking to investors, that's the number they're going to key on. Costs. So expenses. So there's a difference between looking at your expenses and whether or not they're part of your monthly recording in your financial statements, or they are cash, meaning they go out the door. I know that all of you may have heard the term accrual accounting versus cash accounting, and those two words just mean two different things. Accrual just means you're matching. You're taking your costs that belong to generating that sales that you see here, where the net sales is the number, versus when you paid it. So you may end up spending money in a single month that is going to generate a return, because your sales are going to utilize that tool, that effort, whatever, over many months. So you want to be able to understand the difference, that even though you paid for it in January, your costs should be spread out over the next 6 months. Profitability. I cannot stress profitability enough. If you're out there raising capital, if you're talking to people, maybe other founders, where in the last, certainly the last couple of years, that's changed, but prior to that, everybody's about top line. Everybody wants to know you're growing top line, that it's, you know what, your sales are growing, your sales are growing, your sales are growing. It turns out you need to be profitable. So you need to really keep an eye on both the unit economics. So if you're if you're doing SaaS B2B software, if you're healthcare play, that you understand what it costs for every single unit or every single user that is using your product or your service. If that's not profitable, if you are, let's say you're in the product space and your first order isn't profitable because the cost of acquiring that customer is an issue. So you want to make sure that you have a good understanding at the user or unit what your profitability is. If it's not profitable, make sure you have a path to profitability. And then there's business profit, which is really around stage of the business. Most companies, when they're first a startup, they're not going to be profitable. They're not going to have business profit. They're going to be probably unprofitable for quite some time. That's fine, because you're building a vision, you're building on IP, you're building on innovation. You want to then have sure you have enough cash in the form of, well, maybe friends and family, maybe yourself, maybe a bank if you can get it, or if you got some investment, that you make that period of time where you're not profitable as least impact, or that you have enough cash to cover it for the longest period of time, because you want to be able to get to that profitable stage. And here is one that I see a lot of founders make mistakes, which is about sales taxes. One, if you're selling in Canada, and you obviously there's a threshold, you're collecting sales taxes, and you only do an annual filing, which means that cash is sitting in your bank account every single month. And you know what happens? People spend it. And then at the end of the year, when they file their tax return and they all of a sudden realize they have a liability to the government, they don't have the cash. So even if you're an annual filer, you can make installments. I do it. I run my own service business, and every quarter or so, I look at what my liability is and I just pay the CRA. Allows me to sleep at night. Probably it'll help you as well.
Irene, we have a couple questions in
Yes,
the
please.
chat. The first is, how do you account unit economics for a service-based company such as yours, and coaching?
Right. So I think the when you're a service-based business, it depends a little bit about whether you're the person providing the service or whether you employ people providing the service. And it also matters whether it is a productized service offering versus an hourly basis. So if it's you, let's take the early case where you're a consultant, you're offering up your time. My goal always is that benchmark it first and foremost, what you would earn in that capacity within an organization. Okay, that's your cost that you're giving up. So it's an opportunity cost scenario. If I know I could be out there, and if I was working at a job, I could make $50, $100 an hour, hopefully, then that's part of my cost. So I need to understand that I need to bill out at a rate that is higher than that to cover the hours I'm not working in a week. So work backwards. Like I kind of go, okay, this is how much I need to make if I was working full time in a company, and then I'm building in that risk factor of, hey, but I'm not going to be being paid the same amount every week, and that's how you get down to a unit economic model. It also depends a little bit on market conditions. So if you need a lot more than what market conditions are, then that probably means your business idea isn't going to be a successful one.
Perfect. That's a great explanation. Thanks. This question is a bit more nuanced, and it's about profitability. And sometimes founders avoid profitability for VC metrics. I know that depends on what you're going for and what the metrics are, but can you comment on that?
Yeah, so again, it's a little bit around, it depends on the audience here. So if you are in that ideation stage, so businesses go through different stages. And if you're in that ideation, maybe you're in prototyping, you're kind of trying to get to that first MVP, totally appropriate that you're spending your money towards getting the right product. Okay. And I think when you have investors, if they're VCs and you're at that stage, they're not going to expect profit because they can't. They're looking for the long-term play here. So you're at that stage, what you're going to talk about is IP and market access and innovation and stuff that is very transformative to the category. If you're a little further along, however, and you've got a product market fit, you've gone out, you're now starting to gain revenue. At that point, and I do make investments, is we start to think about market access, the size of the market. What do you need in terms of cash to be able to access your customers? What does that look like? And again, in that period of time, you probably aren't going to be profitable because you're still building a lot of it. In terms of, and I get what you're asking is it growth at all costs? Because that certainly was the messaging 3 years ago. I mean, didn't matter if you weren't profitable. You don't even have to show you're going to be profitable forever because it's all about, I'm going to go from every year I'm doing a 3x, 10x growth in my sales numbers, and that's what we care about. I do not see that. I find most VCs are much less forgiving to the idea that you would not be profitable. And I'm assuming when you talk about VCs, you're kind of talking about the general investment community because there is obviously differences. There are really early stage growth investors that are looking for that longer term path to profitability. But if you're really talking to a venture capitalist like a VC or a PE, they're going to be looking for profit. Like you're not going to be able to kind of massage the message around top line growth and not having bottom line profitability. Any more questions, Samantha? Okay, let's move on to talking about the really exciting stuff. I mean, this is where you may be in a situation right now where you've got an idea and you've started on your business, maybe at U of T. Most incubators, accelerators really do look for people to be incorporated, not just be a sole proprietor, but it's not mandatory. Certainly, there's costs associated with having an entity, and there are rewards to having that. One of the things that I find most often is that you want to think about the future. What is your intent about your business model? If your intent is long-term, I'm building this for growth, I'm building this for investment, I'm building this for an exit, you should think about incorporation. If your goal is, I want to have a really successful practice, I'm fill in the blank here. I am an expert in valuations. I'm a psychiatrist. I'm a service provider. You may not want to be incorporated. You could be a sole proprietor. It just means the income you earn goes directly into your personal tax return. There are some nuances, and I talk about risk all day long. which is that if you are a sole proprietor and you provide a service or a product, that if anything goes wrong, your personal assets are exposed. So having a corporation in between means that if there is an issue, the corporation acts kind of as a shield for you. There are costs associated with it. Now, the setup can be expensive, but most of the law firms that I work with in the Toronto ecosystem all have a startup practice. So getting incorporated, the legal documentation, they all have a practice at a reasonable cost. Remember, they're all looking for you to stay with them long term, so take advantage of that. Find a good law firm that you feel good about. Ask what their fees are after. So don't get yourself locked into, oh yeah, this is great, they did it, and now my partner costs me $1,000 an hour every time I call. So keep that in mind. There is complexity around taxes. So you'll have to file a corporate tax return, which is different than a personal tax return, and there's some complexity. Full disclosure, I don't do my own corporate tax return. I have an accountant who does it because I'm not an expert in corporate tax and I don't want to be. So I employ somebody to do that. But it's like, 2, 3, 4 grand a year for costs associated with having an incorporated entity. The last part, I think, because mentally, I think it's important. So this is not about taxes. It's not about accounting. This is about how you mentally see yourself. There's you, the person, and there's you, the CEO. So I think that's helpful. I think it allows you to make decisions differently. A little bit of partition, a little bit of independence. The corporation has needs that are different than you as a person. So I think there's value in thinking of it that way, that you are not yourself and the core and your business at the same time. So those are the kind of thoughts that I have around being a sole proprietor versus being an incorporated entity. And you can incorporate anywhere. So most people here, if you're in Ontario, it's just the easiest is to incorporate right in Ontario. You can incorporate federally. Don't ask me all the differences because they're not really that relevant here. Keep in mind that if we have people that are active in the province of Quebec, that they would like to, that's one of their primary markets, that's where they see themselves or they live there, then you want to think about incorporating in Quebec. That comes with different requirements. I am not a lawyer, so you want to get some good advice on that. But the same thing, Montreal, really robust ecosystem around startups, and they've got great resources. So if that's part of your thinking, go there. And the last thing I will add is that I get asked a lot whether you should incorporate in the US. Because should you incorporate in the US? And there are a number of reasons to do it and a number of reasons not to. So you need to understand both from an operational point of view, tax point of view, and what it does for your ability to sell. Do not incorporate in the US if the only reason is you think people will not invest in you if you're a Canadian company. That is not true. There are many investors, VCs, and everyone who do not care if you're a Canadian company or a US company. Every once in a while, I catch one that does have a specific mandate, but most of them don't care. Most of them will not be a situation. If somebody pushes you to incorporate in the US so they can invest, you should really ask whether that fits with your obligations and your future planning.
That's awesome, Irene. And I'm also going to add, because we had a session all on this last week, is that grants and non-dilutive funding, also your eligibility, if you're an American corporation versus a Canadian corporation, is highly contingent on your national status and other things as well. So be careful.
Yeah, you need to be a CCPC, a Canadian controlled private corp, and that is super important for everyone here that is looking at SR&ED financing. The largest support that the Canadian government provides is through SR&ED, which is the Science and Research something development credit, where they will support you, but that requires a CCPC. So keep that in mind.
We've got a lot of questions coming up in the chat. So Baron, sorry if I pronounced your name incorrectly. If you have a quick question, go for it.
Yeah, I have a question regarding incorporation. I heard that since if you're a small business rather than like relatively big incorporation, businesses like multinational or national, you're still have more like responsibility, and still you are like the business is you basically. How do you look at that? Because I just heard that and I was just wondering, because I know that technically if it's incorporation, you're not the business, like sole proprietorship, but I still, if you're a small business, if you're not in that big scale yet, it's still business as you. Is that correct? What do you think about that?
Let me clarify a little bit. If you incorporate, you become the shareholder of that corporation. So the business is still you. So as a sole proprietor, it just means that your income and expenses go onto your personal tax return. Whereas if you have a corporation, you are the shareholder, which means the corporation records the income and the costs, and then the residual, the leftover, is still yours. So that's not any different. I do think that the costs of running an incorporated business are not insubstantial. By the way, it's not an either or. I did my stuff for quite some time as a sole proprietor, because you can still get an HST number if you're above the threshold as a sole proprietor. So it's not a either or. It can be very much, I'm just doing it now because I want to make sure there's a valuable model here that I can really believe is going to grow. And then you make a decision when it makes sense for you to incorporate. A little bit of legal at that point. If you've got IP and it's sitting somewhere else, so you need to transfer it, not insurmountable. So don't think of it as one or the other. Could very well be one now and two the next time.
Okay, yeah, that explains. And also another quick question, just because you said that if we want to exit the company, we should incorporate. But what if we don't want to exit, but still, while getting the majority of shareholding, but getting some like maybe angel investors instead, or instead of VC, because VC usually wants more equity.
That's a perfect.
Oh, sorry,
Sorry.
yeah, go ahead.
Yeah, it's a perfect question. Yeah, like it's not about an exit. Like that's one of the possible reasons to incorporate. But yes, it's you in order to get investment, and most of the time bank loans that are business oriented, like BDC, or if you need, it's better to be incorporated.
Okay,
Okay.
thank you so much. Yes.
Thank you.
Thanks. We'll keep going.
All right. So next up, my favorite topic of all time, because this is how businesses go under. You can have the best idea, you can have the best manufacturing, you can have the best customer acquisition. Maybe you're going to all of the shows and everybody's excited about your idea, but cash is king, like it always is. You need to look at your cash flow for a couple of reasons. One, you're just going to be able to make decisions rather than guessing. Like you're going to look at your bank account today and go, oh my God, I got like $15,000 in the bank account. Yay, I can do this. And then tomorrow you forgot that you're paying 10,000, you have 5. And you don't know what your cash looks like 3 months from now or 6 months from now. If there are problems, you're going to know real fast. So if you do a cash flow, it means you're going to find out you're running out of cash in a month and a half from now. You have 6 weeks to fix that. And an opportunity assessment. This is all about, can I afford to go to the big show? Can I afford to set up a booth? Can I afford to buy or rent a space? This is all about opportunity assessment and being able to look at it a little bit further in the future. I am a big fan of keeping cash flow as basic as possible. Mark, if you want to switch the slide. So here, this is where I can make the most complicated spreadsheet for you that has all the different pieces. Back to my very first top 5 hits on what you should do for accounting, which is you need to update it regularly. And cash is specifically one of those things. So at its core, it's just your bank balance plus your inflows, and your outflows equals your cash flow. And that is projected, both inflows and projected outflows. Keep it simple. I know I'm going to get on this channel, I'm going to this kind of cash in every single week. I don't need to know 17 customers. Not relevant. Keep it weekly. You need to do this weekly so that you could see as things happen. One, so you'll see how your cash moves around, and 2, when you're going to run out. And the last thing is, make sure it's easy to update. Don't split your credit card bill into 17 categories if that's not how the bill comes in. Make sure it matches your actuals. And this is this big picture, but notice it doesn't have a lot of lines. There's a lot of columns, but also I'm a big fan of color coding, so I can see things. But this is all it is. Top line is like, hey, what's coming in? Middle is like what's going out, and the bottom tells me how much cash I have. So keep it simple. That's one of the things that I would do. And then to my last part, because I'm speeding through here to make sure that Mark has enough time to talk about everything you need for tech, and also that we have time for more questions at the end. This is what I get asked. Should you be the accountant? Or should I hire someone? Okay. And for most of you on this call, you are probably not coming from an accounting background. You're that sales guy, the marketing people, you have an R&D background, you are heavy into deep tech, all the things, except you probably are, is an accountant. I know approximately one guy who started a business who's an accountant, and that's the boss of Growth Partners. So what I do tell people is that you should be the accountant at the early stage. Okay, and this is where Mark is going to show you how to make it easy to do. It's because it's early. You can't really afford to pay everybody for just booking your entries from your bank. You want to know all the parts of your business, how the money is coming in and how the money is going out. You can get help. So call us when you are like, hey, I'm trying to raise money. I need to build a model. Or, hey, I've got a tax question. I'm selling in California. Do I need to collect sales tax? Go and get help for those kinds of more complex CFO level questions. But you can do it. I guarantee you, you're capable of doing a bank rec in QuickBooks. You'll be good. Maybe you should be an accountant all the time. One, because you maybe just love it. So, I know some founders that really it is relatively rote. They don't have a lot of customers. They just have big customers, so it isn't worth spending the money. It also means you stay aware of the costs. I will say that most businesses wait too long to find somebody to help them with finance. And when they do, your brother-in-law, who is an ex-hockey player, is probably not the right person to do your books, okay? Go and find somebody who has both a professional understanding of what a bookkeeping and accounting should look like and is appropriate for your industry and your stage. Be aware, early on there's a question on service and how do you make sure there's unit economics on service? We're the same. Accounting, bookkeeping, CFO service time is all based on the amount of time people spend on it. So if you have clean books, have a good tech stack, you'll pay less. But if you don't, you're going to pay more, or if you underpay, you're going to have an awful lot of surprises. I would say that once you get to a certain size, when you take your first investment check, please get somebody to help you, because investors have different demands than you do. They aren't going to be in your QuickBooks every day and understand what's happened. They're going to want reporting. They're going to have insights. They're going to have KPIs. They're going to make sure that you are following through on what you promised them when you took their money. So you at that point should have a really solid finance partner, whether full-time or fractional. Probably not full-time. Most of the time, these things are still fractional early on. So that would be my kind of how I think about when you should decide to go and have someone else to help you with the finance side. All right. Based on that, I'm going to hand it over to Mark and have Mark talk about the finance tech stack.
Yeah, thank you. So then really, yeah, the tech stack side is really gonna operationalize a lot of what we just talked about. So what a good tech stack should do for you is it should give you insights into how your operations are actually doing, and then inform the actions that you need to make. It should also save you time. So like you shouldn't be having to spend a lot of your time trying to like chase down receipts or doing any type of manual input. It should basically be like one small thing on your plate, and then it gives you time to focus on the things that matter, like your sales and product. And it can actually like save you money. So like things like making sure that taxes are paid on time, so you don't incur like any of those nasty fees, as well as giving you insight into where your money's going, so that you can pull back as you need to, it can actually help you save you money, even though it does have a small cost to it. So that's why you should really care about this. Few of the indicators where you may need to make a change to to your tech stack. So if you find yourself like throughout the week like spending too much time on admin, there's probably a tool out there that can help you with that. So as well as if it's taking you a lot of time for your accountants or for you to also close your books, and then and then like you don't have the information at the time that you need it to actually run your business. There's a lot of tools out there that can make accounting really easy for you to do like each week or every couple weeks so that you always know where you stand. Um, Oftentimes, if you aren't using the right tools, then there may be errors that are going to creep through in some of your operational processes. So if you're doing customer billing and it's a very and I'd say like it's a messy process where a lot of data is flying all like over the place. Like those are things that you want to avoid because it's never good having to show a mistake to a customer or vendor or an employee. So then tech stack can help to automate a lot of those things and and then take those things away. It can also help you get cash in the door so that you never have to worry about that. So like it can help to automate the billing as well as how you actually collect the money. So there's a lot of tools out there for that. And then yes, you can do your accounting and some of your operational processes within a spreadsheet. But I'm sure you've all, at one point in your life, been in what's called um, spreadsheet hell, where you have 4 or 5 different sheets and you're trying to paste it all to kind of see where things are at. So there's definitely a tool out there that can take you out of that. So um, in terms of some of the tools that we often use, so I'd say like right when you incorporate and you need to start filing your taxes, but then at the very least after you have ha, have after you have raised some money, it's very important to have a proper accounting tool in place. There are some tools out there like a Wave that are going to be like slightly cheaper, but I would say to invest in either QuickBooks or Xero. It's not a huge cost, which I will get to in a sec. And then that's really going to form the ecosystem for you to add in tools to make other parts of your accounting um, very efficient. So like once you hire your first employee, I would definitely recommend putting in a proper software to pay your team. Couple options there for whether you have team members on this side of the border or on the other side. And like the biggest thing here is really the compliance side. Yes, you can find a way to calculate the taxes and then the payout via checks and save yourself a bit of money, but you are likely going to miss one of those taxes and then pay your fees on it. When it comes to like the end of the year, when you have to do all those tax forms, it's going to be a pain. So I'd say it's really important to invest in that. Um, as as the bills start to kind of build up, as you have different vendors and contractors, yes, you can pay them yourself. I'd say like under 10 via the banking platform you have. But then at some point, you're probably going to want to offload that to a accountant or perhaps like an operations person. And then a tool like Pluto can help to set up that workflow. So like some person on your team can set up all the bills to be paid. You just click approve, and it helps to automate some of the accounting as well as keeping like the vendors um, in the loop so that they aren't chasing you down trying to say, hey, where's my money? So a couple of things that can just help you save some more time in your day. The other thing, like as your teams start to grow, and perhaps you want to give them the ability to spend, tools like Float and Ramp can really help to scale that. So then instead of doing those expense reports within a spreadsheet, you can issue them cards, either like a monthly card or also like a one-time. to basically like replace expense reports, make it easy to scale spend across your team, but also do it in a controlled way where they can only spend up to certain amounts each month or week, and they can only spend on certain things. And then as your customer base starts to grow, and I'd say the billing automation side, it's going to depend on your operations. Like if you have a lot of recurring invoices each month, there are tools out there that can help with that so that you just set up once when they close the deal and then you don't have to worry about it. But also like maybe if you're like a B2B SaaS where you have like a closed deal, that contract needs to turn into a recurring billing. Tools out there can help with that flow so that you don't have those errors. It can also help you get cash in the door faster. And then also keep an eye on those top line um, um, K, 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 KPIs within the platform. And the one other tool here that can help. So if you are looking to raise funds or also just keep an eye on how your operations are doing, oftentimes this will kind of live within a spreadsheet, which is fine. It's definitely the most flexible tool. But I'm sure we've all had that experience where we've had to copy paste information from different places. So a tool like Coupler can help to connect those two so that it just becomes a click of a button to take information from your accounting software, put it into your model. So just so that you can keep up to date, which I'll show you a bit of a view of that on the next one. So yeah, here's a bit of a view of as you start to implement these tools, this is what your infrastructure can look like over time. And then I'd say definitely not like you have to implement all these things right from the first day. But then really like QuickBooks or Xero becomes like your core accounting kind of database. And then information from the other systems start to push and pull in so that it's easy to do the accounting as well as you have that right level of information that you need. And then information can get pulled out of your accounting software into any other KPI dashboards or models that you have with just a click of a button. So that's just how all the tools kind of integrate with each other. And I will suspect that maybe some of you are thinking, why are there like all these tools? It's a common thing. And I'd say that the approach we take to our tech stack is really a more of best in class approach, where like we are going to implement like the tools that are best at what they do, so that each process you have is as efficient as it can be. There are some tools out there that can start to consolidate some of these things, but like we have found that like you may not get as much efficiency across your AP, across your spend, and then you would be kind of losing out there. Often, sometimes these are also much more expensive. If you're looking at more of like a NetSuite or a Sage Intacct, then like it just wouldn't make sense to invest in that. So the other thing too, like you can add these tools in very easy as your business needs scale and as well as your cost can scale as well. So it makes it super easy for you to manage that. In terms of cost, so here's a bit of a view of what some of these things cost. So then you can see here that none of these costs are really gonna break the bank. And you can definitely add in the accounting software first and then add in these tools as you need it. So I'd say like definitely under like $100 for like core needs that can grow over time. Obviously the kind of biggest number is the billing tool. And that's one that we typically recommend like it makes sense for you to implement once you reach a certain scale. It is a bit more of a lift to put in place as well. So yes, that is the tech side, but like none of it's going to work unless it kind of aligns with the rest of your operations. So you of course have to choose the right tools. So I have kind of shared a few of the tools that I'd say work with most of our clients. But then we always do a bit of like a needs assessment because every operation is a little bit different. But you need to have the right people on your team involved in the right processes So just so that someone's looking at how the information is flowing between your systems, the right people are involved at the right steps. And then that's where basically like the process sides comes in. And once you can merge all those things, then you will get the outcomes that you want. So a bit of like how you can execute on that. So break it out into the 3 steps really. So with the planning, you obviously need to choose the right tools based upon your needs and the outcomes you want. You can compare to like a few options out there, but I wouldn't go and like start to look at like 5 or 10. Keep it to a few, and then you should plan how that's gonna change your operations within your tech stack. Obviously, some of these wouldn't be that much of a change, and then it's pretty easy to insert. But say like a billing tool, once you put something like that in place, that'll change quite a few different things. So it's always important to have that planning step in place. And then you have to prep. Like you can't just like kind of um, um, like you can't just buy a tool and then do a couple of things and then it works. Like there's a bit of prep that you need to do. So you need to look at how it's gonna work with the other tools in your tech stack, what the processes are gonna look like. Make sure that everyone on your team understands what the processes are and then what they need to do. And then oftentimes there's also some information that shouldn't be moved over from either like your spreadsheets or perhaps other tools. And then at that point, you should be ready to launch effectively. And then at that point, it's really having the right people there to kind of support your team and keep an eye on how the information is flowing between systems and then track how those outcomes that you hope you got in the planning stage, and then you can always tweak from there. So just a bit of an overview of how to put this into action. And then here's our plug here on kind of what we do as a team. So I'd say the clients that we work with are in that like early stage and startup phase. So typically 1 to 15 mil, but like I'd say like we do have exceptions outside of that, kind of in that series or the seed to Series A range. And then in terms of what we can do is really from that kind of lower level accounting, doing like your monthly books, doing your ARAP, up to more strategic type work. So helping you be ready for any type of funds that you want to raise, or helping you manage your cash flow, as well as what I do on the tech side, which is putting the right tools in place. So we have the team to help you, and then you can basically pick and choose which of those items like fit your needs. And yeah, so I'd say like that kind of wraps up the content. So perhaps I can open up the questions. I do see a few in the chat there.
I think we're good in the chat right now.
Oh,
I do have one question that James Wiles had asked a little while ago, and it's a bit of a deep dive into when is the right time to move shares into a trust?
Oh, yeah, I saw that. I added a comment there.
Oh, I see.
That's
Yeah.
it's an interesting question for this audience because that is so that's part of a planning tool around if you are perhaps thinking about an exit in the long term, what does that look like? Do you have a trust? Isn't a trust, by the way, is expensive to operate. So we talked about incorporation. A trust is more than that. It has more legal, it has more obligations. There's returns that are earlier. People utilize trusts purely for sharing in the reward so that these are details, but obviously within Canada, the taxation system rewards founders that have a capital gains treatment. So when you sell your business, you aren't being taxed on it like regular income. 50% of it is not taxable. And then there is an exemption. So that makes incorporating in Canada and Ontario, and as Samantha, you pointed out earlier, keeping that CCP status in mind, really important because that matters a lot for return on investment. I think most companies, and don't quote me, but what I see in the landscape in Canada, most companies sell between 20 and $40 million. They don't sell for $1 billion, although notwithstanding some of our really great exit stories. So think about that usually is part of the tax planning exercise. How can I be most effective at optimizing my after-tax income? It should not be done without a lawyer. It should not be done with an accountant who understands how to do the trust properly. So this is not quite, I wouldn't pretend to be the person who knows all the ins and outs. This is one of those ones where I look at my assurance partners and have them go do it.
Beautiful, thank you. Does anybody else have any questions? You're welcome to raise your hand or put it in the chat. Or just unmute and get at it. Go for it.
I would love to hear from some people that are in the audience right now, what stage they're in and what product they're at, and where their development's at. So it doesn't have to be a question. I'm always curious to listen to really great startups.
Awesome. We have some UTest startups in the audience I could see.
Yes, so
you're
please
welcome
ask the
to
question.
jump in and like tell them about your startup.
Yes. I see Baron has raised her hand again, so you get to ask the question.
Can I ask a question, or do you want the other person to talk about their startup? Because whatever you say, I go with.
Go ahead and ask the question. I'm sure
Okay,
whatever
yeah.
question you have, other people do too. They're just shy or they.
Yeah. Okay. So although I seen that it's like a tech stack is all good and all, but I'm also like honestly, the money is scary, you know, the keeps trying to keep up your cash flow and making sure you're like be able to pay yourself and also the others maybe if you have employees. So having all those the different tech stacks, it's a bit like scary in a way. So is there any like AI, or is there a way to make sure you can like, is there like a one general that uses the other ones to make sure they are all in line, or what is the best way to approach that, like when you start getting investments? Because I feel like it might be a little bit hard to keep track of all the different automations, because it's not gonna be automation at that point. It's gonna be like you're gonna spend so much time like making sure everything is working properly. Maybe it's not the case for everybody because, but it's just, yeah, I just had that question. Hope it makes sense. Like, yeah, you guys are experts, so I believe in you. But as a early startup, I just want to make sure that I have a clean and simple way to understand as well. So yeah.
Yeah, I'd say like um so like I'd say like all the tools that are in our tech stack are not ones that like you would necessarily like need to hire an accountant to use. It's like a lot of these tools can be used by someone with like operation experience and so on. So and I would say like look at it from the standpoint of yes, there might be a couple $100 per month in systems dues, but it's going to give you back a lot of time during the week. There's also going to be like hidden costs that you're not going to incur, like kind of and like tax fees. But then also like, it's going to allow you to maybe push out that accounting hire like a little bit later because you have the right tools in place. You can manage it in house a bit more. So yeah, I'd say like yes, there is some cost to it, and there's a few tools. But there are some tools out there like a vendor loop that are consolidating some of these processes. And I'd say like they can be cheaper than if you added up some of ours. So like that's something that you could definitely look at. You just may not be as efficient with some of the processes, but yeah, like it could be more of a cost-effective approach to start.
Yeah, I would say that the first thing, if you're not, look, this is the start of a tech stack, invest in an accounting program. Both QuickBooks and Xero. We pick on those, by the way, not because there's other offers that are just as good, is that when you're eventually looking at hiring this stuff out, most of the bookkeepers are aware and know how to work in one of those two programs. So that doesn't mean you can't use another one, and just keep that in mind. Just like the service side of it, people aren't going to want to learn another program. Right now, QuickBooks is like their starter pack is like $14 a month. And Xero is even lower than that. So do your research, go look around and see how much that works for you. And then add the tech stack pieces as you, I thought Mark, if you want to go back up to one of your slides, he did a really good job at showing the kind of the stages that help you decide when to get what. This is what you need. Like, so it's not the big slide, although that is it is one of my dreams come true, Mark, is that slide there. But this is where pick and do in phases. So, and in terms of cash flow, I think you asked about that, Baron, as well. Start with a spreadsheet, list your costs, list your expected incomes, and then move from there. It's not, I wouldn't want to discourage you from thinking that you need to have all of these things in place at once. You have the idea, you're the innovator, you know what you're trying to do. So I support that wholeheartedly.
My fear is a bit that, like, what if the AI or the system makes a mistake in a way, and it gets back to me in a big way, because especially for tax things and stuff like that. So what is the error rate, or like, what do you think about that? Because I don't know if these are AI or just more like automation tools, as in like make it easy to like convert, as in like in Excel with the things. But I just wanted to ask that, because especially with AI, I know that there can be mistakes and you need to keep asking, for example. So how is it with these programs?
So one of the good things about accounting is that if you took is that it's set up as a double entry system, meaning that it's designed in the first place to not have mismatches. So in most of these tools, yes, they might have automation, but it doesn't mean AI is telling you whether your cash is going to run out. That's why I have the lowest level tool in there, which is an Excel spreadsheet for your cash. So that is and if that's a worry, that's why part of the stage was go ahead and be the accountant first yourself, so that you know how QuickBooks Xero Wave, how it works. So when you process a bill, that you could see what it did, that you understand how the information got to be before it is a mistake.
Yeah, makes sense. Thank you so much.
Great. I think we may have time for one more question. If anybody has something that they would like to ask or share a story of their startup or anything that they found helpful in this presentation, you're very welcome to share. That would be great. Okay, so Ethan asks, Irene, would you recommend a corporate finance course for STEM majors, or is it learnable?
Oh, it's totally learnable.
Cool.
I think a corporate finance course, like I love mine. It's also one of the hardest things I ever did, I think, at U of T, besides my stats course, although I did very well in that. But I think that's really about understanding how to practically use your accounting system, which is very different than kind of like discount cash flow models or valuation of options, like those kinds of things. So on a practical level, I would say, you know what, buy, and I'm a big fan of QuickBooks. Buy QuickBooks, hook up your bank account, hook up your credit card. It'll do a lot of the entries for you, and then you can see what's happening. If you want to learn more, I think there's an awful lot of really good courses online that will give you the slices of the information you need. To go back to school and get a corporate finance course is hey, feel free. If you plan on doing an MBA, by the way, that's part of what they include for most. That's a big piece of an MBA, right? Is that corporate finance, all about finance. Like, let's be honest, that's what they do. So if that's part of your thought journey, then you'll get some of that in that course.
Brilliant. Thank you. Do we have time for one more question? I believe Mark had one, or something that he wanted to share, or anything.
Thanks very much for the great program. Just very quickly, we're a startup out of U of T. We've incorporated, but we're not raising funds yet. We're still in tech dev. We've been pursuing a lot of non-dilutive funding in the form of grants and proposals and stuff. We don't have any sort of a tech stack set up yet, and we haven't had any real money come in yet that hasn't gone through the university lab. But we have a corporate entity, and as soon as one of these comes in, which we expect sort of any month now, we're going to have the problem of money in hand and no tech stack to support it. It's what I heard today. It sounds like we should get QuickBooks or Xero as sort of a first step so that we can start addressing the problems that we're about to encounter. Is that
Yeah,
sound
Mark, I
right?
think the first step is come talk to us. And we
Okay.
have no more time left, so reach out to Mark and or myself directly, and we'll chat.
Okay, thank you.
Okay, so I'll make it super, super short, but I want to give a huge thank you to Irene and Mark for this brilliant presentation. I think you did this excellent version of having the high level information and the detailed information, that perfect balance in order to start making decisions for tech stacks and accounting and just get going on it, which is a lot in startups of getting going without having all the answers. So we'll let you all go. And thanks again to our friends at Growth Partners. And we'll be sending out the deck. And if you have any further questions, you're always welcome to get in touch with me or Mark or Irene. Their contacts will be in the deck when they send it out. And thank you so much one more time, Mark and Irene. This is great.
Awesome to be here. Thank you so much.
Okay, take care, guys.
Appreciate the opportunity. Thanks, guys.
Bye.